SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF Baffi Bocconi webinar on the international role of the euro, tectonic shifts in the global financial system. My name is Ernest Gnan. I'm SUERF Secretary General and Counsel to the Board at the OeNB, the Austrian Central Bank. This morning, the ECB published its 21st report on the international role of the euro. We are privileged to be among the first to have the ECB experts to present key findings of this report while it is still fresh from the printing press. Isabel Vansteenkiste, Director General, International and European Relations of the ECB, and member of SUERF's Council of Management, as well as Arnaud Mehl, Advisor at the International Policy Analysis Division of the ECB, will start out with a presentation of key results and messages in the next 30 minutes. A special focus of this event will be on the question whether the Russian invasion in Ukraine and the Western economic and financial sanctions may have longer-term implications on the role of various reserve currencies and on the international monetary system at large. This theme is also covered in a box in the report. We are happy and honored to have two world-renowned scholars as discussants with us today. Barry Eichengreen, Professor of Economics and Political Science, University of California, Berkeley, and Robert McCauley, non-resident Senior Fellow of Global Development Policy Center in Boston University and Faculty of History at University of Oxford, will discuss the ECB's report and bring in their own perspectives on today's special focus. Without further ado, Isabel and Arnaud, over to you.
Good afternoon, everybody. This is basically the 21st report on the international role of the euro that we're going to present to you here today. And we're, of course, very grateful to SUERF to have us here today to present this work, but also to find two great discussants for this work. I mean, we're always happy to get some views on where we should put our analysis and our focus next and on some of the more thorny issues. So as Ernest also already mentioned, the report, besides discussing some key developments in the international role of the euro in 2021, also contains some analytical boxes. So this is an interim report. We have every 2 years, we have a full-fledged report. So this is a shorter version in the report, but the report does contain some analytical focus topics. And of course, one which we could not, of course, ignore and could not have in the report was a discussion on the implications of the war on the international role of currencies. But there are also some other developments, of course, that we should not lose sight of. And one, for instance, is, of course, on the internationalization of the RMB. The report takes some stock on to where we stand in that regard. And there are also some new insights from sectoral developments in international loans. And there's a further look at the exchange rate elasticity of trades and the link with the invoicing currency. And finally, of course, a topic that we see a lot discussed, in financial press, but also, of course, at the global level in terms of the need for potential further regulation is the development of stable coins. And here we look in particular at euro-based stable coins. But before going through these analytical boxes, let me spend a few minutes in just reviewing the developments on the international role of the euro in 2021. And here this chart shows our composite index of the euro's global role. So it's rather a simple composite index. It basically just gives you a simple average of the share of the euro in a number of main indicators of global currency use. So for instance, we can think of the use in international reserves, international bonds, global foreign exchange markets. You can see basically in the footnote, which is quite elaborate to this chart, the details of all the indicators that were included to come up to this composite indicator. Now, if you zoom in the very most recent periods, and you can see that in the red circled area, what we can see is that the euro's role remained broadly stable in 2021. At constant exchange rates, and this is the blue line, we can see that the index remained unchanged overall. At current exchange rates, there was a marginal increase, but I would really say it's very small. You can also see that when you just look in the chart of 0.1 percentage points in 2021. Now, of course, that would kind of ignore, if you would just zoom into these very recent periods, the kind of evolution we have seen over time. And there we can, of course, see that the euro's global role continues to hover at historically low levels. It's important to note, especially for policy discussions about how a stronger role of the euro could contribute to the EU's strategic autonomy. And of course, those who follow maybe EU policies more closely may have seen that this discussion has become more to the fore in EU fora, and that was already even before the war. And of course, it has become even more prominent now. Now, of course, you saw in this composite indicator the aggregates. Now we can also decompose it into the various subcomponents, and this is what this chart shows. It shows in these bars the developments in a number of indicators between end 2020 and end 2021 of the euro's global appeal at constant exchange rates. Now, what you can see is for some indicators, they were essentially stable. These are the ones we see in the middle in the chart here. So, for instance, import invoicing. Some have declined. You can see them on the right-hand side. The most prominent here would see, for instance, foreign exchange settlements. But other indicators have actually increased. We see that, for instance, in FX debt issuance, international loans on the left of the chart. So overall, the stability that we see on aggregate in this composite indicator kind of masks some increases in some indicators and decreases in other indicators. Now let me turn in a few more details on some of these sub-indicators and start with the share of euro in global FX reserves. Now, why do I start with this one? I mean, it tends to be the most traditional indicator of a currency's international status. And here we can see that the share of the euro has slightly increased at constant exchange rates to almost 21%. This is shown in the blue line. It's a bit hidden by the red line at the end, but you know, the blue line more or less increases like the red line does. It's just overlaid by the red line. Now, at the same time, if you look at the US dollar, we see it remains the leading global reserve currency, but its share has declined quite a bit in 2021 by more than 1 percentage point. And now it stands overall below 60%. I mean, that is a 2-decade low. I mean, we'll come back to this stealth erosion of the dollar. I think this is a phrase that was popularized in recent work by Barry shortly. But like turning back to the euro, what moderates the appeal of the euro as a global reserve unit? And here we see that remuneration is one factor. So if you look at short and long-term interest rates in 2021 in the euro area, they remain negative. That you can see on the right-hand side chart in the red circled area. And interestingly, according to a regular survey of official reserve managers conducted by UBS, this is an investment bank, in mid-2021, around 86% of respondents cited this as was on the prime concerns for their investment strategy. And this was up from 70% in 2020. Now, while mentioning the survey, let me also give to you that overall the sentiment among official reserve managers towards the euro might have improved, with 1/3 of respondents indicating that they were planning to increase their exposure to the euro. Now we have to see if the incoming data will confirm what they are saying in their survey. Turning to the next indicator, looking at international bond markets. Here we also saw some interesting developments in 2021. First, if you look at overall developments in the left-hand side chart, you can see foreign currency denominated bond issuance was strong. And this was driven by a global economic recovery from the earlier disruptions caused by the pandemic, but also ample fiscal and monetary policy stimulus. If you look at the issuance, we see that it overall decreased by 10% to more than $2 trillion, as in the left-hand side chart. Now, if you look at the decomposition by currency, we can see that the issuance of foreign currency bonds in the euro was particularly dynamic. So the share of euro in international bond issuance increased by almost 3 percentage points to 25%. And you can see that in the right-hand side chart in the blue line. But of course, this is still dwarfed by the US dollar, which remains the by far leading currency in international issuance of foreign currency denominated bonds. Although its share did fall last year by around 5 percentage points in 2021. You can see that in the yellow line on the right-hand side chart. Now next, zooming in on the subcomponent, and we look here at the role of the euro as a currency in international green bond markets. I mean, this is still a small market segment, but it's rapidly growing. And this is important because it suggests that developing well-functioning and liquid euro market for sustainable and green finance can bolster the euro's international role. Now, if you can see overall, international green bond issuance grew rapidly in volume overall in 2021. And of course, the share of the euro increased significantly. If you look at the blue line, for instance, we see this steep increase. However, of course, you see also in that chart, the yellow line increased even further. So if you look at the decomposition by currency in shares, as shown on the right-hand side chart, we can see that the share of euro-denominated green bonds declined in 2021, whereas the share of the US dollar increased. At the same time, we see quite some potential for the euro to remain very important in the expansion of the green bond market. And an important factor here is the next generation EU stimulus package. Just to give you some figures, in October 2021, the European Commission issued a 12 billion green bond. That was the largest ever issuance in this specific market segment. And the plans of the Commission is to issue up to 250 billion in green bonds as part of the NGU bond program. So that will make it the largest issuer of green bonds globally. Now, taking an overall picture here, we're looking all in all, we can see that in some dimensions the euro role was increased, but in some of it decreased, and overall we had a broadly stable role overall, and that makes the euro still the second most important currency globally. So that's visible here in this chart, with the global share of the euro hovering around 20% for most indicators of international currency use. That's well below the dollar, which is ranging in a share between 40 and 60%, but well ahead of other currencies, and particularly if you look at the Chinese RMB or the Japanese yen. And on the RMB, as already indicated at the start of the presentation, we'll come back later through the analytical boxes. So this covers the developments in the international role of the euro in 2021. Let's just turn to the analytical boxes. Let me start by reviewing the potential implications of the war on the international role of currencies. So now this is a big question, and there's been a lot of debates on whether this could be a game changer, whether it could fundamentally alter the importance of major currencies in the international monetary and financial system. It has been argued that the sanctions taken by the US and the EU, for instance, could encourage some countries to bypass the US dollar and the euro. So to give some examples, Russia and other countries may try to diversify their portfolios into alternative assets, such as Chinese RMB, gold, or crypto assets. Moreover, for instance, international payments could become more segmented. Russia has, for instance, we have seen this, demanded to be paid in ruble for gas exports by what it calls hostile countries. And there are press reports about discussions between Russia and other countries like China, Saudi Arabia, India, on using local currencies to pay for international trade. And also China's cross-border interbank payment system could grow in importance as an alternative to SWIFT, especially within the Belt and Road Initiative. Importantly, recent research has highlighted the stealth erosion of the US dollar in global foreign exchange reserves. The invasion could accelerate this. This erosion you can see here, for instance, on the chart in this slide, on the bar with the red arrow, is the share of global foreign reserves, which has fallen by 10 percentage points for the US. Largely to benefit the RMB and other traditional reserve currencies. The implication of the apologies, this is the COVID side effect. Arnaud, can you take over? I have to cough too much.
You step in? Yeah. Okay. So the implication of the Russian invasion of Ukraine on the global appeal of the major currencies are not clear. So I guess one should nuance those conjectures that have been made. For starters, shifting global reserves do not necessarily predict broader changes in other dimensions of international currency use. You see that in the chart which is on the right-hand side with some evidence of that. What is true is that the share of the dollar did decline in foreign exchange reserve in the past 20 years. That's the red bar on the chart. That's the stealth erosion that Barry, with co-authors at the IMF, recently popularized in influential research. But what's interesting is that in other dimensions of the dollar's use, the share of the dollar, in fact, has been stable. But it has even increased a lot in other measures. So one noteworthy measure of that is the share of the dollar international bond issuance, which has grown strongly since 1999. Moreover, and that's perhaps a second consideration to have on one's mind, the alternative to the dollar and the euro, such as the RMB, gold, or even crypto assets that have been mentioned, in debates. They all lack the market depth, the liquidity, or the stability that appeal to global investors, and in particular to global official investors. Finally, the invasion of the Ukraine by Russia is a reminder that sound institutions and geopolitical factors are important determinants of international currency status. There's recent research by Barry, myself, and another ECB co-author that suggests, in fact, that military alliances like NATO can boost the share of a currency in military partners' use of currency to a significant extent. So it's not necessarily that certain that the invasion will bring about fundamental changes. There are other forces that pull in the other direction. What will happen? Well, time will tell. That's something that probably we will discuss in this webinar. Now, there's more specific analysis in the report that also speaks to this question, which is scattered around the other boxes that we have. And for instance, there is one box in the report that shows that despite recent headways, the renminbi's global role remains relatively limited. There are three factors that support the internationalization of the renminbi. One is its inclusion in major global bond benchmarks. There is also the progress that the Chinese have been making towards developing a digital yuan. And now perhaps the sanctions that have been taken after Russia's invasion. Now, admittedly, the role of the renminbi as an investment currency has increased. For instance, if you look at the left-hand side chart, you see that as a global reserve currency, that's the blue line, the role of the renminbi has increased. And that's also the case of the importance of the RMB in portfolios of global private fixed income managers after its inclusion in global bond benchmarks. But the role of the renminbi remains modest in many other dimensions. For instance, it's less than 1% for international debt and loans. These are the red and the yellow lines on the left-hand side chart. And in global trade invoicing, which is often thought as an important dimension of international currency used by influential theoretical work, the share or the importance of the RMB is really tiny. The data that we have suggests that it's less than 1%, 0.2% to be precise, of global trade invoicing. So that's really, really small. There are several factors that continue to weigh on the global appeal of the renminbi. For instance, the incomplete openness of China's capital and financial account, and the lack of flexibility of the renminbi's exchange rate, or at least that's a standard story that researchers have thought about. And it's also not clear that the slight increase in the weight of the renminbi as part of the revision of the special drawing rights, which happened, I think, a month ago, will support the international use of the renminbi. So it's true that the share of the renminbi in the SDR basket did increase, but there was no really strong effect of the inclusion of the RMB in the SDR basket back in 2016. So question remains whether this increase will result into bigger effect for the renminbi's global appeal. Another piece of evidence which is relevant to the debate as to whether the Chinese renminbi could rival the dollar and the euro in the wake of the recent geopolitical developments that we've seen is that, quite tellingly, even if China is now the world's largest international official creditor, ahead of the IMF, ahead of the World Bank, ahead of the Paris Club, most of the bilateral loans that China gives are in dollars. They're not in RMB. The share of the renminbi in China's official bilateral lending is low. It's about something like 11% between 2000 and 2017, when you average out the share of the RMB in all those years. And it's true, to add a nuance to that in some countries or in some parts of the world, the share of the renminbi is usually much higher. And you see that, for instance, in a few countries in Africa and in Asia. These are the countries which are in the darker shades of blue on that map. Okay. Now moving on to crypto assets, and in particular to stablecoins, which are also it's an investment vehicle that has been mentioned in the debate as to whether Russia's invasion of the Ukraine could trigger some rebalancing in the role of currencies or even digital currencies. There is specific analysis on the report on crypto assets, and in particular on stablecoins, which are those digital assets that are designed to minimize price volatility against other assets, such as fiat currencies or commodities. And here the report shows that the global stablecoin market is essentially, it's a dollar's stablecoin market. And you see that on the left-hand side chart. The market cap of stablecoins has surged in the past 2 years, but most of them are in dollars for about something to the tune of $200 billion. That's the yellow line on the left-hand side chart. And less than 0.2% are in euros. So it's really small. It's something equivalent to $500 million. And that's the view line. Moreover, those euro stable coins are not only small, but they're also volatile, illiquid, and risky. And you see that on the right-hand side chart. Here we have some measures that in periods of market stress, the returns of euro stable coins, that's the blue bar, which is indicated by the red arrow, are negative, just like the returns of other risky assets, like equities or Bitcoin. So they don't really offer attractive diversification opportunities in terms of safety, unlike what their name claims. And they are unlikely as a result to appeal to investors looking for safety, like official reserve managers. Another piece of evidence that we have in the report, which is interesting from that perspective, is that stablecoins are also mostly acquired as vehicles to trade in other crypto assets. And to see that, you can consider the two charts that we've put up here. They both plot changes in trade volumes in Bitcoin against two stablecoins since 2020. So the one chart on the left-hand side is the trade volumes of Bitcoin relative to dollar Tether, which is a dollar-denominated stablecoins, and the one on the right-hand side are the trade volumes of Bitcoin relative to Stasis Euro, which is euro-denominated stablecoin. If you look at the one on the left-hand side chart, you see that transactions in dollar Tether strongly co-move with Bitcoin transactions and positively. That's also true for transactions in Stasis Euro and Bitcoin on the right-hand side. There's still a positive correlation, but it's weaker. But all in all, that evidence essentially suggests that stablecoins are not necessarily considered as a new financial asset class, but rather as a vehicle for transactions in more volatile crypto assets like Bitcoin. Transactions in those digital units go hand in hand. All right, we talked earlier about the potential developments in the role of the euro as an invoicing currency, as to whether the Russian invasions of the Ukraine would trigger some rebalancing in the role of various currencies in trade payments. It's important for our understanding of the relative importance of international currency, but it's also important for central banks like the ECB, because that affects how exchange rate movements impact trade and inflation, something which is known as exchange rate pass-through, which is important for monetary policy, which is why we try to dig a little bit further in the report on that particular question. Now, the report has new empirical estimates on this for the role of the euro exchange rate and exchange rate pass-through. Consider first the short-term impact of a euro depreciation on trade volumes. These are the first two panels on the left-hand chart of that admittedly complicated chart. But if you just focus on the first two bars on the left-hand side, you will be able to follow what I say. The higher the share of exports which are denominated in euro, according to these new estimates which we have, the stronger will be the rise in export volumes following a euro depreciation. That's in fact very intuitive. If prices are settled in the euro, the weaker euro is immediately reflected in export prices faced by customers in their own currency, because they feel richer as a result of the depreciation of prices which they see in euro relative to their own currency. Turning to euro prices, or more precisely what we call trade unit values in euro, these are the last two panels on the right-hand chart of the slide. The higher the share of prices invoiced in euro, the less an exchange rate depreciation of the euro will affect euro prices. And that again is also intuitive. That reflects the fact that when prices are invoiced in the euro or settled in the euro, they're sticky in the short term in the euro, which means that prices will move when the euro depreciates or appreciates. The key takeaway then is that euro area export and import prices and hence euro area inflation is partially shielded from large euro exchange rate movements when a sizable share of trade flows of the euro area is invoiced in the euro. Okay, let me conclude now with the final box of the report before I drop on the main messages of the report. This final box of the report was done by one ECB economist and a co-author at the Bank for International Settlements, an institution that Bob knows well for having spent many years of his career at the BIS. And one good thing about the box is that it puts to good use newly enhanced disaggregated BIS data on international loans, which helped us to examine the increasing importance of non-bank financial intermediaries in the global financial system and see what this means for the international role of the euro. Now, the box focuses on the fact that euro-denominated international loans to non-bank financial institutions has expanded in recent years, and that the euro is an important financing currency in that particular segment of the international loan market. If you look at the left-hand side chart, you will see that there is remarkable growth in amounts outstanding of euro-denominated loans in the past 4 decades, and that expansion was largely driven by loans to banks until the mid-2000s. However, loans to banks declined substantially during the global financial crisis and the European sovereign debt crisis. There was a big deleveraging in loans since that period. By contrast, loans to non-banks have become relatively resilient and they continue to rise. And what's striking is that in recent years, there's been a marked increase in the share of non-banks, which now accounts for about half of total euro-denominated international loans. And on the right panel, you can see that most of the rise in euro-denominated international loans of these recent years is attributable to non-bank financial institutions. That's the area which is shaded in blue. Essentially, these are like insurance companies or pension funds, even special purpose vehicles or money market funds that get loans in the euro, in particular in the US and in the UK. Now, that's important from a policy perspective because those non-bank financial institutions are, by some observers, expected to play an increasingly important role in the global financial system. Now, if that's true, the key question then will be whether the development of that particular sector will support the global appeal of the euro as a financing currency going forward. That's also something that we will discuss. Okay, I think we're done now in the 30 minutes that Ernest awarded to us. So it's time to conclude with the report's main messages. Essentially, if you look at developments in the international of the euro in 2021, there's been stability in the role of the single currency. Importantly, about 2 months ago, at the political level, the EU Council, which is essentially the gathering of heads of state and government in the EU, stressed that a stronger international role of the euro is a key pillar to the EU open strategic economy. The recent development that we have seen underscore the fact that the union's economic and financial resilience to the current geopolitical challenges can also support the international of the euro. And in this context, the policy implication that we stressed in the past for the international role of the euro remain valid, insofar as international of the euro remains essentially supported by deeper and more complete economic and monetary union, the capital market unions, and sound economic policies. And with this, I'll thank you for your attention.
Thank you very much, Isabel and Arnaud, for this really very rich report and the very condensed presentation that you offered to us. Really very insightful and interesting. I now hand over to Barry for a first set of comments and perspectives. Barry, over to you.
Thank you. So I think Isabel and Arnaud should be congratulated on the latest installment of this indispensable report. We all turn to it whenever we talk about and think about these issues. The headline of the report is that the international role of the euro remains broadly stable. My restatement of the headline would be, why hasn't the euro gained more ground on the dollar in the last 20 years? And will Russian sanctions change this? Specifically, will those sanctions lead to a shift away from dollars and in particular benefit the euro? I would observe in passing that the Bank of Russia already held more euros than dollars well before the invasion of Ukraine. The latest foreign exchange and gold asset management report of the Bank of Russia, since taken offline, observed that the bank held 32% of its reserves in euros and only 16% in dollars. So that may reflect on ongoing reserve management trends or anticipations of what might have followed. Who knows? Still, my answers to the questions, why hasn't the euro gained more ground, and will the Russian sanctions change this? My answers are respectively no and no. There's nowhere to go for those seeking a meaningful alternative to the dollar, because European countries and what I would refer to as subsidiary or non-traditional reserve currency issuers all joined in the sanctions, with the exception of China, which itself is reluctant to look like a sanctions buster for fear of secondary sanctions consequences, so forth. I found it interesting that the report pays as much attention as it does to the international role of the renminbi. I will acknowledge being a bit more skeptical about that than the authors. Only 11% of China's official overseas lending is denominated in renminbi, although those are data stretching over a couple of decades, so it would be useful to update them to the most recent period. China's cross-border interbank payments system referred to in the report is still a pale shadow, if you will, of the New York Clearinghouse of Chips and the UK equivalent CHAPS. It's notable that China's system still uses SWIFT for 80% of its cross-border messaging. The report makes a point that I like to emphasize, that reserve managers, central bank reserve managers, and others value rule of law. They value good governance. And speaking frankly, China falls short along those dimensions. And I think there is an argument that Putin's recent actions, Russia's invasion of Ukraine, will remind those international investors, official as well as private, of President Xi's ability to arbitrarily change the rules of the financial game. So I think the more important gainers of recent events in the intermediate run will be issuers of subsidiary international currencies, countries with good governance that are already benefiting from lower transactions costs in trading their currencies, increasing scope for direct trading, not having to go through the dollar, improved market liquidity, lower bid-ask spreads. In other words, maybe the availability to them of Federal Reserve swap lines, more generally, more attractive risk return trade-offs, Sharpe ratios, in other words. And that reference to Sharpe ratios makes one wonder whether the coming non-zero interest rates in Europe will make a positive difference now for the euro's international role. So I've heard the likes of Goldman Sachs argue this. There's a reference in the report to the UBS survey of reserve managers from a year ago where they pointed to this. I have my doubts. If anybody is going to be raising interest rates fast, it's going to be the Fed and not the ECB. So whose Sharpe ratios are going to be improving? Not improving the most, not obviously the euros. What about the prospects for the euro more generally? I've found missing from the report a discussion of the shortage of AAA rated safe public label assets in the euro area, that there are only 3 euro area sovereigns with AAA ratings when I last looked, and some of them, like Germany and Austria, don't issue a whole lot of public debt. So my own calculations, together with Daniel Gross, suggest that US treasuries held outside the United States are fully 6 times in value AAA rated public label euro denominated securities available to the rest of the world, after you net out those held by the European Central Bank, those held by European commercial banks as reserves, and so forth. Conceivably, next generation EU bond issuance could change this. So I think that comes up in the report only in the context of green bonds and would benefit from more extensive discussion. The question there is whether that 850 billion euro bond issuance is a one-off, or whether it's Europe's Hamiltonian moment, as some people like to call it, even that 850 billion euros is a significant increment to the availability of investment-grade euro-denominated public debt. But again, it would have to be followed up on. And I've been struck by the fact that there's very little discussion in the euro area, in the European Union, about another tranche in the context of the Ukraine invasion and the energy shock with its asymmetric impact and so forth. I was also struck by the absence of discussion of CBDCs. So there's one mention so far as I could tell in the report. Once upon a time, it was believed that CBDCs would transform international payments, and that this made it imperative for the ECB to issue a digital euro in order to enhance its international role. The authors will be reassured. I've always thought that argument was spurious, if you will. Cross-border interbank payments are already digital. A SWIFT message costs on the order of $25, 25 euros, which is peanuts in the context of a wholesale transaction. So while I noticed the absence of discussion of CBDCs, I noticed the presence of discussion of stablecoins. I'm not quite sure why that emphasis on stablecoins in the report. Could it be that the authors are tempted to make the same argument that's typically attached to CBDCs, namely that stablecoins are about to take over international payments, and that a currency that lacks stablecoin capitalization will lag behind in the race for international currency status? I would also reject that argument in this case for two reasons. One, the same objection as with CBDCs, namely that cross-border transactions are already digital, so any savings will be minimal. Two, stablecoins are not viable. Either they're not stable, as we saw just yesterday with turbulence in the crypto market, or they won't scale. If you have to fully capitalize or fully collateralize or over collateralize them, they become so expensive that they won't save anyone who actually uses them in payments. Still, I found the section on stablecoins interesting. I myself have a paper with Ganesh Natraj in Asian Economic Papers that provides more evidence, extending the evidence in the paper that most stablecoin transactions are actually in connection with purchases and sales of other cryptocurrencies. In other words, they're not used for conventional payments. Finally, there's the observation that the vast majority of stablecoin capitalization is in dollar-linked coins, not in euro-linked coins. So if I read the paper correctly, 1/5 of 1% of stablecoin capitalization is in euro-denominated stablecoins. It could be that a majority of other crypto transactions are undertaken by folks whose natural habitat is dollars, by Americans, in other words, making a dollar-linked stablecoin the natural on-ramp and off-ramp. And while data from the likes of Chain Analysis are imperfect, they do suggest that US investors hold on the order of 6 times the crypto of the next most heavily invested country, the United Kingdom. Or this could just be another example of those mysterious complementarities between the different functions and domains of dominant international currencies, similarly emphasized in the report. So lots to think about. We're grateful to the authors for directing our attention to these issues.
Thank you very much, Barry, for these extremely rich comments and also a little bit critical, which is always stimulating. Very good. I think it would be good if I gave immediately Isabel and Arnaud the opportunity for a first set of reactions so that you are not overwhelmed by the many comments.
Thanks a lot, Ernest. Maybe I start and Arnaud compliments me on things I forgot or overlook, or maybe he disagrees with me on some things. I don't know. Let's see. But thanks a lot, Barry, for these comments and these insights, and also for giving you your take on some of the recent developments that we see. And I think there are some points I think that we would just agree to, and other points where I think some clarification also from our side, would be helpful and useful. And maybe I start with the last point on the stable coins. Why emphasis? There was a box in there, but the box was not necessarily intended to emphasize that stable coins are about to take over the market, and we think that's an important factor in the international role of the euro. Actually, quite the opposite, and I think there's also some reference in the box actually in the importance of regulating these markets. So there was not necessarily a view there that we think this is important. Actually, we see it more as the opposite, and we see more risks in these market segments than opportunities. So in that regard, I think we may be more on the lines that you were referring to, basically. On some of the other points, I mean, just maybe on the next generation EU. Where you also made some reference on where is this heading? Is this the Hamiltonian moment in Europe or not? I think this is, of course, a big point of discussion, and I think there's different views on that. And of course, if you ask an ECB view or so, I think we would rather see, at least in future crises, that similar instruments could be deployed, so that this is not a one-off and never again. But of course, then it depends on how you would define a crisis and at what moment you think such an instrument should be activated or not. The fact that it's basically been designed as a one-off, of course, means that it's not really, the full definition. It doesn't meet the full test of what we would call a safe asset either, right? There's very low credit risk, but of course the liquidity is not fully there, and it's of course a great instrument that we had that was deployed in the crisis, and it was extremely important. But of course, being it a one-off, that of course hampers to some extent the liquidity of these issuances. So I think there is still some way to go to see this as a fully nucleus of some sort of fiscal capacity or so. In general, indeed, I mean, we see still some shortages of AAA safe assets, but I guess it's not just, you of course refer to the US, but I guess it's also a phenomenon across the globe. So I don't think the euro area is completely, or the EU is completely standing out in that regard. In terms of the prospects of the international role of the euro and what we see on the interest rate side, yes, I mean, we see normalization. I think most central banks label it of policy, and of course, if everybody does that, then your relative position doesn't necessarily change. But that it matters, I think we already see, at least when you look at Japan, right? So if you look at the fall in the Japanese yen recently, in particular, as Japan is continuing a course of very easy monetary policy, we see clearly some differentiation there. So it does show that return also matters in these cases. So it will be interesting, of course, to see how things pan out if we move back to a positive interest rate world rather than a world where some currencies, have short-term or long-term debt in a negative territory. But I agree with you that, of course, it's the relative position that matters more than the absolute in regard. Finally, I think on the bigger questions, why the euro didn't gain more ground vis-a-vis the US, and will the sanctions change any of this and benefit the euro? I mean, just on the second one, I would fully agree with you. As all countries kind of, all the major jurisdictions impose sanctions with the exception of China, then, I mean, it doesn't put the euro in a very different basket than the United States. So I wouldn't see that any reason why the euro would, in relative terms, benefit relative to the US. Also, there's, the euro is not doing anything in that regard currently that would make it benefit in relative terms relative to the US. I mean, why is the euro not gaining more ground on the US dollar? I mean, that's of course a very good and pertinent question. And one thing that we of course always refer to, which is important to foster the international role of the euro, is of course fostering the capital market and banking union. in the euro area and in the EU. And of course, this is something when we talk about the integration in the EU, that this project gained a lot of momentum, let's say, in the aftermath of the sovereign debt crisis, but has recently quite a bit stalled. And for sure, that is also not helping to push further the international role of the euro. And that is something, I think when you look, we may have some background slide or so of the factors that are important to support the international role of the euro, but this element is of course an important one where we're still having some way to go. But with that, I leave the floor to Arnaud. I'm sure I forgot to say something, or maybe he has a different take on some point. So please go ahead.
No, you didn't. You provided a comprehensive answer. Barry, I just wanted to say you regret that we didn't cover the shortage of highly rated sovereign issuers in the euro. Yeah, I mean, rightly so. No, we didn't speak about this last year. It was an editorial choice and said that we had like a full special feature in last year's report, so we didn't want to put the onus on this yet again. Maybe this was the wrong editorial choice, so then it's my fault. That's also true for the CDBC. There was also a special feature last year, so this year's okay. Let's do the stablecoin one instead, just to try, and it's always a challenge to come up with something new and hopefully exciting. So that was just an editorial choice rather than an attempt to minimize the importance of those two issues, which indeed are instrumental. Thank you.
Thank you, Isabel and Arnaud, for your replies. We now turn to Robert McCauley. Bob, over to you.
Thank you, Ernest. Appreciate the opportunity, and I want to thank the authors for a marvelous report. Once again, it's Christmas in June. I want to associate myself broadly with the theme of the box in the report, that it's not at all obvious the sanctions and their aftermath will make a big difference to the selection of currencies in official reserves. I'd like to proceed to ask, what will the impact of the freeze be on currency denomination of reserves, by asking, how did the Central Bank of Russia fortify its reserves, sort of fortress balance sheet, between the time of the Crimean annexation and just before the invasion of Ukraine? At that point, there was a clear anticipation that sanctions already implemented could be tightened. So what did the CBR, the Central Bank of Russia, do? I think we can gain insight by looking at what they did. And in brief, they moved out of the United States. They more generally diversified their country risk, and to a rather limited extent, they reduced their holdings of dollars. The important distinction is between country risk on the one side and the currency holdings on the other. So the Central Bank of Russia fortified its balance sheet along four dimensions. First of all, it modestly increased its foreign reserves. Second, it raised the share of gold. Third, it reduced the extreme concentration of country risk that it had back in 2013. And it seemed to reduce the dollar share quite a bit, but I shall argue that that's overstated. Increased reserves, despite the sanctions in the years from 2013 to 2020, the CBR actually increased its reserves by 24% to $630 billion by the end of 2021. It increased the share of gold. Essentially, all the increase in its reserves went to gold, which went from 8% of foreign exchange reserves plus gold to 21%. And the CBR profiled gold as its largest holding. It drew attention to its location in vaults in the country. I might note that it's not particularly useful if you want to mobilize your gold for credit or any other purpose to have it in the vaults in your own country. Third, the CBR reduced the concentration of country risk in its portfolio very substantially. In 2013, exposure to the top 3 countries of France, the United States, and Germany amounted to 80% of Russia's foreign exchange reserves. By 2020, their share had more than halved to 36%. The beneficiaries here were China and Japan, which received most of the corresponding increase, with weights going up from 0 and negligible to 19% and 17%, respectively. In particular, the CBR reduced the onshore share of dollar holdings. Now, given the US propensity to impose sanctions, the CBR fortified its reserves by moving dollars offshore, away from US jurisdiction. Assets in the United States fell from 31% of foreign exchange reserves in 2013 to 9% in 2020. The reported onshore-offshore split reversed from about 70-30 to 30-70 between 2013 and 2020. Such a high offshore share of dollar reserves is very unusual. The global norm is something like 15% offshore. Indeed, the CBR placed more of its dollars, it appears, in Japan in 2020 than it did in the United States. Let me come to the currency composition. Submit that the CBR reduced the share of its dollar holdings quite modestly. Now, on the face of it, the CBR de-dollarized very substantially between 2013 and 2020, reducing the greenback share of FX reserves from 45% to 28%. The euro share, I'd note, held up better, slipping from 42% to 38%. The gainers were the RMB with 17% of FX reserves in 2020 and the yen with 5%. Barry's smaller currencies, the Canadian dollar and Australian dollar, their share didn't change much at all. These are the headlines, but the footnotes of the Central Bank of Russia annual report point to more dollars off balance sheet. Forward sales of foreign currency against foreign currency amounted to 9.5% of FX reserves in 2020. Now, it's hard to be sure, but these are most likely dollars swapped for yen and RMB. If so, the CBR held about 1/10 of its FX reserves in what you might call synthetic dollars. For instance, an outright investment in yen securities combined with a forward sale of yen for dollars. So in effect, a dollar reserve. And if so, the dollar share of exposure fell to 38%, just about the same as the euro share, as we read in the headline. And why do the swaps? Well, they can both raise dollar yields and keep the dollar exposure out of Uncle Sam's reach. So stepping back, the CBR changed its country risk exposure, the where of its FX reserves, much more than its currency exposure, the what. It lowered its US exposure most and its French and German exposure as well. Both made sense if the US was the most likely source of new sanctions, but at the same time, the authorities in Russia weren't sure where else sanctions might come from. Now, partial reporting for the end of 2021 shows a halving of the dollar share and a notable rise in the RMB share. But without the data on the FX swaps, it's hard to interpret these moves, although it's almost certain that the CBR cut exposure to US country risk further in the year 2021. So what are the lessons? The first lesson of the CBR's fortifying its reserves is that even a central bank preparing for sanctions might mostly maintain its dollar share. Despite the US preeminence, if that's the right word, in sanctions, and despite an official policy of de-dollarization. Offshore dollars and synthetic dollars out of the immediate reach of US law can substitute for onshore dollars. The second lesson is that effective country diversification may have to go to uncomfortable lengths. The very broad imposition of sanctions frustrated Russia's diversification, China apart. With 2020 hindsight, to diversify effectively would have been to take the credit risk of placing reserves with, say, Brazil, India, South Africa, as well as China. Again, with 2020 hindsight, the Russian authorities might have sought less a fortress balance sheet and more a siege stockpile. No doubt stockpiling semiconductors and airplane parts is a lot harder than accumulating reserves. But Russia these days lacks key imports, not the means to pay. In sum, as reserve managers ponder how to defend their reserves from sanctions, they could seek to avoid U.S. country risk more than the dollar. The dollar share of FX reserves, properly measured, might not suffer so much. But country diversification might not work unless extended to higher risk countries. The management of the $3 trillion in reserves of China, certainly a special case. It faces limits in diversifying country risk. Even given a willingness to take more credit risk, the bond markets of currencies that have not heretofore attracted official reserves pose practical challenges. The status of the BRICS local currency bond fund initiative is not clear, but in any case, its scale would be very small in relation to China's reserves. Thank you.
Thank you, Bob. Very, very interesting. What you tickle out of the official statistics is really fascinating. So, I mean, to overstretch your argument, active shifts in the Central Bank of Russia's US dollar reserves, etc., could have been used as a leading indicator to future aggression. Now, this seems like an obvious move, what the Central Bank of Russia did, but why did we fail to interpret it correctly is an obvious question. Now, having said that, again, let's have an immediate round of reactions by Isabel and by Arnaud.
Thanks a lot, and thanks a lot for Bob. Indeed, interesting, the amount of information that is actually out there. We sometimes search a lot for information, but in this case, the Central Bank of Russia had quite some information published so that we would understand how the composition of the reserves looks like currency and locationally wise. Of course, I mean, as you mentioned, I mean, hindsight, we can kind of see this building up of this war chest. I think some even called it by the central bank as preparing for what's to come, and it wasn't. I guess there were people out there that saw it coming, but it was not generally the widespread view that was voiced, until exposed when actually the events took place. But I think what is still interesting is that, of course, you see this move away from US dollar and into alternatives, but in the end, I'm of course not in the mind of the Central Bank of Russia or Russian authorities, but I would assume that there was still some element of surprise that sanctions were, implemented by such a range of countries, so that basically it didn't only had an impact on US dollar reserves or the reserves located in the United States, but also other jurisdictions implemented similar measures, right? So the EU is one, but also Japan. And I mean, that this had a significant impact was quite obvious if you saw the initial reaction to these financial sanctions in Russia, if you saw how much they had to increase basically their interest rates and the measures that the Central Bank of Russia had to take to counter these implications. Of course, at the same time, some discussion is then coming subsequently on why we have seen the ruble almost recovering to or above the levels what we saw before the war. And of course, the CBR has lifted a lot of these measures since. There's still a lot in place, but there's been a lot of lifting of measures. But of course, an interesting discussion is there, of course, on the imports, the exports of key commodities such as oil and gas, where they get a significant amount of US dollar revenue still, which is of course still significantly helping their balance of payments. And I think there's also interesting research increasingly on, to what extent there's a link between sanctions and the currency itself, so the ruble, where of course it's not always obvious in which direction it goes. But I think the main lesson is that maybe while they try to shield themselves from the US, it was still very difficult to diversify out of real international currencies. So and as you mentioned, and I think what the box also in the report discusses is that the alternatives are not really there, you know, and basically in terms of liquidity, in terms of governance, institutional quality. So the whole discussion that maybe countries may have learned lessons from this, that one should move away from holding too much reserves into, I know I'm going to be broad-brushed and say the West, you know, without detailing countries. I think at a second glance, the conclusion will still then be that it's really, really difficult. And actually the whole financial system is so interlinked and so based on, in particular, the US dollar, that it's very difficult to move away. And as Barry also mentioned, for instance, the role of a global payment messaging system such as SWIFT is still very important as well. And so moving away from all these options and putting yourself into alternatives which have less liquids, you know, less stable and less safe alternatives may not necessarily be the way that countries will choose to go. So I think this is also what we had kind of in the box. You know, there's the first reaction of saying, you know, you may want to move away from the West, but at a second go, if you start looking at the alternatives, they're not really out there yet. So that would be my overall reaction to what Bob was saying. But I think a broad agreement overall. But maybe Arnaud also wants to chip in some words on this.
No, I was as usual impressed by Bob's ability to make the statistics speaks in a way that none of us here probably could do. I mean, I liked a lot your conclusion that it's probably easier to reduce your exposure to a particular country like the US, but not necessarily to the currency, either in the form of you know, offshore dollars or synthetic exposure to the dollar. That's something which is really very interesting observation, and I guess that's something we should start working on for next year's report, because that's a very interesting point. Thanks a lot for that, Bob.
Thank you, Isabel and Arnaud. Before we go to more detailed questions and answers with the audience, I propose we first give Barry and Bob once more the opportunity to react to the various points that have been made meanwhile. Barry, would you want to start?
Very briefly, I appreciated Bob's distinction between currency denomination of assets of reserves and domicile of those assets and reserves. And indeed, that distinction does feature in the Bank of Russia report that I referred to in my remarks. They report both, so they seem to be highly aware of the distinction, consistent with Bob's remarks. As Isabel said, they may have overemphasized in their own minds the importance of that distinction, because offshore to the United States, dollar reserves were by and large frozen by foreign governments and central banks as well. And I wonder whether that's something that we should expect as a regularity going forward, that a country like Japan tolerates the existence of a market in Japan dollars because its own reserves are liquid and it can expect swaps from the Federal Reserve. So if the U.S. authorities say your dollars are going to remain liquid and you're going to continue to receive swaps from the Fed, only if you go along with our foreign policy imperatives, we should expect this kind of unanimity to be the rule rather than the exception.
Thank you, Barry. Bob, do you have any further comments?
I just underscore in response to Barry's point that I was drawing on the Central Bank of Russia data, and that kind of crossing of currency and location was sort of best practice among central banks. You could see that in the Riksbank annual report. I mean, they would also tell you the difference between their exposures after swaps versus just the raw cash exposure. And the Central Bank of Russia did not draw out that distinction, though their footnotes did give you the numbers for how big the swaps were in aggregate, though it didn't reveal what currencies were involved. So there was a certain amount of sleuthing or supposition on my part in that. So the question Barry asked was, should we expect things to be as they were in Russia going forward? And no doubt Isabel is right that there was a surprise in among the Russian authorities that the sanctions ended up being as broad as they were. But I do suggest that the diversification of the country risk that's evident in the years between 2013 and 2020 suggests that they were not operating on the theory that only the U.S. might tighten the sanctions. And I think there were, back in 2014, there were sanctions not only out of the United States, but out of the EU as well. So there was certainly precedent for a broader scale. But I think the point is well taken that almost surely there was surprise that it was as broad as it was. Are there no alternatives? You know, people not long ago would have said that China was not an alternative. And it's not inconceivable that we have other alternatives that are not on the hit parade of reserve currencies now, and certainly these events could move the system in that direction towards small currencies, or not so small currencies, that are not on the Fed's swap list. I think could be something, a direction of movement for the international monetary system. But I recognize that the markets and the politics and general assurance of potential official investors are not strongly supportive of that at this stage.
Thank you, Bob. So, I mean, if I may paraphrase your last point, I mean, it seems a little bit like the idea, or this idea is a little bit like what we observe in many countries, actually not in the US, but in many European countries, that we move in political systems from bipolar system to multipolar system. So many smaller parties, which implies much more uncertainty, but also much more much more diversity. So I interpret your last idea that we might as well use move towards a more diversified global monetary system, a multipolar monetary system, as one option. Now, another idea that that is out that one might conceive is, you know, if you look at the recent political developments in the past, a little bit over 100 days, in reaction to the war in Ukraine. Now, NATO and the Western countries, they have strongly moved together in terms of political unity and defense and so on. Now, a question is, might a similar thing also happen or be worth considering in terms of the global currency system? So there is still one dominant major currency, the US dollar. There is another Western currency out there, the euro. So might these two currencies, in a way, be linked together more closely in order to strengthen each other's, clout? Or alternatively, what role might be there for the SDR, which is never mentioned actually in such discussions, for good reason or not so good? Might the SDR ultimately, or as an option, benefit from in such an uncertain environment? I have 2 or 3 further questions, so I don't know. Maybe I add another one, which we have out here, which is, on the benefit of an international currency. Now, if I look back at the discussion of the past 20, 30 years, in Europe, there were different views on the benefits or drawbacks of an international currency. Germany was traditionally pretty much on the brake because it could, disturb domestic monetary policy and so on. Now, more recently, the EU is quite in favor of the euro becoming more international. There was this interesting box on the small role of stablecoins, and the authors actually gave good reasons why this is the case. And Bob, you also went into this. But the question is this actually a disadvantage, or is this actually an advantage if the euro is not, strong in the stablecoin market? Is this something really one should regret? And linked to this, we have also one question in the chart. It was already touched upon a little bit in the presentations, but we might go deeper into that. It is a sort of a normative question. Irrespective of the economic financial fundamentals, how can we make the euro truly international in the absence of a fully fledged monetary and fiscal union and an unfinished banking and capital market union? Is this actually in the power of the ECB, or is this not too much pressure on the ECB to deliver on such a topic, as long as the fundamentals are not right? So I leave it at that, and I then finally have a final round of questions in the drawer. So I don't know, maybe Isabel, Arnaud, do you want to start?
Yes, I mean it's quite a handful of questions, so I cherry pick a little bit. I pick and choose what I want to discuss, and then maybe Arnaud can pick up some others, and the other colleagues can also maybe pick out what they feel most comfortable discussing. I mean, just maybe one thing, still picking up on what Bob was discussing, and also on the alternatives to, let's say, the dollar or the euro, or we naturally go to the RMB, for instance, and of course there was this box in the report, but I think an interesting discussion one can also have there is basically also to what extent you may be China and you may want to have on the one hand this kind of international currency, and you may see the advantages from that. Also, if you see in the context of the war now, it is important to have an international currency. I mean, this is why, for instance, the West could put these financial sanctions on Russia, for instance, right? I mean, we were able to do that because we have international currencies. But at the same time, I mean, China seems to be very much focused on its own domestic stability. So it's not clear to me whether they actually will have their focus in their policy priorities on developing the international role of the RMB going forward. And in particular, if you still want to have, to some extent, an export-led growth strategy. And I mean, this was also historically what the German economic model, right? And then, of course, you don't want to have necessarily this. It's not necessarily compatible, let's put it like that, with fostering then the international role at the same time of your currency. So I think that will be an interesting development going forward to monitor, and particularly now you see also with the China zero COVID policy again. I mean, there's very much will be a focus, I think, in China on domestic stability, and of course what Barry already mentioned as well. They have not imposed sanctions. They have not joined the sanction regime, but I mean, they were also very careful on steering away that any sanctions may fall on them, right? And they have been taking sometimes a rather hands-off, and took a step back in some ways on all of this. No? On some other questions that you raised, Ernest, I think, yeah, it's a very good question also to what extent we can make the euro a truly international currency when we don't have, you know, a fully integrated capital market and a fully integrated banking union. I mean, this is my personal view. I'm a bit skeptical on that, right? And I think, you know, there are many determinants that make that you have an international currency, and I'm not the one to go through them here. I think Arnaud and Barry and others have done a lot of research on that, so I don't want to preempt anything that they would say on that. But I think liquidity and depth of financial markets is clearly an important one, and of course, you know, having a single monetary policy and having a sound institutions and well-designed and credible monetary policy is important, but of course it does not compensate for some other factors, and it should also not necessarily be seen as compensating for some other factors. So I think this is really a challenge, and that's why, of course, also in the report we continuously emphasize this deepening of the EMU as an important factor there. And I would say also, if you look at the EU strategic autonomy, you know, I think that they produced quite a lengthy document, so I don't think most people have maybe gone through reading it. But of course, deepening EMU is also listed as an important factor there. So I would, you know, really emphasize this as something that is very relevant. And I think on the question, as you said, you know, the benefits of an international currency, where Germany used to take a bit of a different view than some other countries in the Eurozone. I think France was more in terms of promoting international role of the currency historically. I mean, I think partly, I think I would tie that also a little bit to, you know, the kind of German economic model overall, where, you know, the kind of promoting an international role of the currency was not necessarily compatible with that. But with this, I mean, I'll leave it to Arnaud and the others to pick out some other very interesting questions that you raised. I don't want to monopolize the debate here.
Arnaud, do you want to follow up?
You know, maybe just pick one, because I don't want to crowd out Bob and Barry's time. And you had a question on why is the SDR not more used? I mean, I don't know. It's been 50 years that the SDR is. People have been hopeful that the SDR would play a bigger role, but so far not much has happened. I guess it's only the IMF, and you have some exotic use of the SDR. I think the Suez Canal prices are in SDR. That's about it. And the reason I suppose is that it's difficult to understand what's the economic problem that the SDR would solve for official reserve managers. If you want to gain exposure to the dollar, the euro, the RMBs, the pound sterling, and forgetting another unit which is in the SDR basket, you can just hold them directly. Why would you gain exposure to those currencies through the SDR? And you can't do much with it because you can't pay with SDR. Nothing's invoiced in the SDR. You don't have you have a few financial assets that are issued in the SDR, but not much. So there's no direct economic use of it. But okay, I'm curious what Barry would think about this. But that would be my view on that. Thanks.
Barry, what is your take on the SDR or on the multipolar system versus, you know, sort of moving together more closely between the US and Europe?
My line on the multipolar system is that I've been predicting movement in the direction of a more multipolar system for 10 years, and I'll keep predicting it until I'm right. It's developed more slowly than true believers in a multipolar international monetary and financial system had anticipated. And as I've been emphasizing recently, it's developing in different directions, not simply in the direction of a tripolar system, but in a more widely diversified international monetary and financial system, insofar as we see that movement. On the SDR, I am a skeptic. I think what supports the dollar's exorbitant privilege in part is the ability of the Fed to intervene in markets when such intervention is necessary, to provide swaps at its own volition to foreign central banks as necessary. And governments are not prepared to let the fund act as a lender and liquidity provider of last resort, big time, to intervene in the markets on a Monday morning as necessary. So no global government means no first order role for the SDR, in my view. And finally, your question, Ernest, about stable coins virtue or vice. I do think of them a lot like I think of subprime mortgages, that the U.S. is the leader, and that may not necessarily be a good thing.
Thank you. Bob, what's your take on these questions?
I agree that Europe should not bemoan its lack of so-called stable coins. It's a misnomer from the word go, as we have learned a bit, and we will learn some more. On the role of the dollar and the Fed's willingness to underwrite that global role, one thing that happened in March 2020 that I think hasn't received the attention it deserves is that the Fed, perhaps without trying to, underwrote not only the global dollar banking business, but also the global dollars bond business. So when the Fed said that it would buy investment grade US corporate bonds, you saw a reaction by all of the dollar bonds issued all over the world, and not just US corporate bonds. Junk bonds responded immediately, and only later did the Fed also say it would buy US corporate junk bonds. But the Fed never said that it would buy, and it never bought any bonds issued by any non-US resident, any non-US company. And yet those responded both in price terms and in flow terms, if you look at US mutual funds, in much the same fashion as the US corporate bonds. So the Fed, by putting just one finger on one part of the scale, move the whole world of dollar bonds. And this is a key observation, because the world is less and less a world of banking and more a world of bonds. And the Fed's ability to backstop the global dollar bond market is very important, given that the activity, the financing is tilting that way over time. So the Fed's global role has, I think, if anything, been understated.
Thank you, Bob. Before we go into a final round, which I will announce in a second, I want to ask actually a more detailed question to Isabel and Arnaud. I found quite interesting your map on the China loans, or Chinese renminbi loans. And from what I now recall quickly is, so you showed the fraction of loans denominated in Chinese renminbi. And there were very few countries where these loans by China to African countries, basically, where the color was deep blue. That means a high fraction of 75% or something in renminbi. And then there were some countries in the middle, and very few further countries. So my question is, I mean, all of us know that emerging markets, developing countries are getting credits from China. So what are the incentives for the lender and for the borrowers, China and the African countries, to either do this in Chinese renminbi or in another country? And what is this other country? Is this US dollars or is it euro? Why does it differ so widely across countries that receive loans from China? And what are the incentives, or the likely or the possible incentives?
So in fact, these are not our data. These are the data collected by Christophe Trebesch and a number of researchers. It's called the AID data, and they have done really interesting work to try and understand precisely that question. Insofar as there is not so much information as to, what are the covenants in the loans that China makes to those countries? It's very opaque, and they have an enormous research project. I think for many years they used a lot of people to actually try and find documentation on those loans that for some reason got published, because most of the loans in fact are secret. Perhaps because sometimes they had to be ratified by Parliament or other reasons. And they collected a lot of information on those loans in this database. And the incentives are, I wouldn't say, I mean, the ones that you would expect. So first thing, so most of the loans are in dollars. That's one thing. Second, when they're not in dollars, the use of the RMB is accepted by the counterparty in exchange for something else. And this something else will vary depending on the country. So it can be access to a particular facility, access to a particular infrastructure, or whatever. It's loan specific. But it's something which is on which a lot of research effort is spent on, not by us in the ECB. So we are in a way the customers of those data. And given the rising importance of Asia in some parts of the world, particularly in Africa and in Asia, and also in the context of the Belt and Road Initiative, that's something that would be that we need to be researched more, and we need to enhance our understanding on this, especially because the magnitude of those loans is just now gigantic.
Thank you, Arnaud.
That the renminbi disbursements are being used by the recipient government to pay for the services of Chinese construction companies, which in turn implies they don't contribute very much to RMB internationalization.
Interesting. Now, as a final question, very short, I think can be answered very briefly, not very easily, but very briefly. Barry has made clear that he predicts a multipolar international global system whenever this will happen, but at some point you will be right. Now, I'm also inviting the others to provide their prediction. What will be the system in 5 or 10 years? Will it be more multipolar? Will it be tripolar? What will be the gainers and the losers among currencies? Isabel, you want to start?
Okay, when I thought about multipolar, I was thinking I would agree with Barry, but I was seeing a bit further in the future than you say when you say in the next 5 or 10 years.
Let's say 10 years, yeah.
I think in the next 5 years it will still be dollar denominated based, but I think indeed we will go to a more multipolar system. And I agree with Barry actually that it's not going to be a tripolar, but really a multi currency. So it's going to be more than just 3 currencies dominating. Not to start speculating which or who or what. I think that's a bit more tricky. I think it's already enough prediction to say in 10 years we'll have a more multipolar monetary system.
Yes, indeed. In these times of inflation predictions, one needs to be careful. Arnaud, do you have the same view, or do you still discuss within the ECB?
No, here I need to have a disclaimer. I mean, I've worked almost more than a decade with Barry on those issues. So I would say that most of my thinking on this actually is not mine. It actually is heavily influenced by the Barry things. And we have a book that where that prediction is actually pushed for. So there will be no surprise that I also think that the question is the horizon, as usual. No, that chances are that the international monetary system would become more multipolar for the simple reason that this is more the rule than the exception when you look at 200 years worth of history. The key question is, what multipolar means. Is it an oligopoly of a few major currencies, or something which is more fragmented? There, I must say that I'm not too sure. I mean, I see arguments in favor of one theory and others in favor of the other. Not sure I have a particularly strong view at this stage. I see that Barry now as views have evolved slightly towards the idea that let's say subsidiary currencies could rise in importance. Or maybe I'm caricaturing what Barry says, but on this I still need to think about it. That's something that Barry and I will probably discuss over the next 10 to 15 years, I suppose.
Bob, what's your take on that question?
I guess I always see it as a duopoly now, 80% most things dollar euro, and I see no reason that's going to change materially. the balance between the two could shift a bit. The euro's at a low, but I don't see the duopoly changing.
Thank you. Now, this concludes our workshop. Thank you very much to Isabel, Arnaud, Barry, and Bob for this excellent exchange. I find it really very, very encouraging that on the final point, we did not 100% agree, because this would really make me worry. If we agreed too much, this would be groupthink, and groupthink is always bad, you know, in predicting the future. Thanks to all for your interest and for participating. Bye-bye and take care.
Thank you, and thank you to everybody for joining in and listening.
Thank you. Bye-bye.
Thanks to all.
Bye-bye.
Bye-bye.
Bye-bye.